Broadcast is now starting. All attendees are in listen-only mode.
All right, thanks for joining us today. Just going to wait another 30 seconds or a minute, see if any late comers sign in here. All right, we'll get started here. This is going to be a general overview of the technical analysis on Briefing's website, as well as different methodologies that I particularly use to try to get an edge when you're trading stocks. Just as an intro, my name is Scott Smith. I am the Senior Technical Analyst here at Briefing. Been here for about 10 years. I've been trading the market since mid-90s, I'd say, so well over 15 years. I also post trading comments under BlueChipTrader, under the BlueChipTrader service that we offer. Mostly I cater towards a swing trading approach, and I usually try to hold positions for as long as I can. I'll take partials off during the day if I immediately enter a position and it's starting to work in my favor, say for like $1 gain. I'm probably going to take a little bit off the table just because it's a quick gain, but then I'm going to usually let the rest of it ride into a swing trade. And that's pretty much how I approach all the ways I look at charts. If you have any questions, there is a chat box on the webinar, the GoToWebinar thing. You can just drop questions in there. I'm going to try to save them all the way until the end at the Q&A session, and I'll try to get to as many as I can. Let's avoid, since I'm going to hit a lot of broad topics, let's try to avoid just focusing on one specific stock and asking my opinion, like what I think of Apple or Facebook or something like that. Let's try to keep it, on topic to the webinar. Let's see. Can I just, if anybody can do me a favor and tell me if they hear anything? I'm being told people can't hear. All right, it sounds like people can hear. Good, people can. All right, you might have to turn your volume up if you can't hear me because I got it. All right, that's thanks for the feedback. All right, let's get started here. Let's see. A couple highlights. First off, I'm going to show you where to find the technical analysis on briefing.com. For those of you that are new, I'll show you some quick areas, and for those of you that are more experienced and been subscribers to this site for a while, maybe you're learning some new places. So to start, you should probably be on this Briefing in Play page. I prefer the dual page that's here. But most of the technical analysis is going to be under the Investing and Trading drop-down menu. And down here it says Technical Analysis. The first one we have is going to be Liquid Momentum. And this is a proprietary ranking of the 50 most liquid, high relative strength stocks in the market based upon our fundamental and technical criteria that we've crunched through a computer. If you scroll all the way down, you'll see that there's the list of it's up to 50 names. Depending on market conditions, it could be well less than 50. But these are typically going to be your strongest, most liquid momentum names in the market. If you're looking for day trading and swing trading candidates, or just trading options, doing anything, these are going to be some of your top go-to names. If you've been trading for a while, you can see that there's actually some really good movers in here. And we actually trade a lot of these on the Briefing Trader service on a day-to-day basis. I also update these charts. These are just kind of generic trend lines and key support areas, moving averages that I try to point out on a few names. It's highlighted maybe, say, 2 to 3 times a week, depending on market conditions, what I see, how I feel about the market. It's definitely subject to my own approach to the markets. So that's one area to get, technical analysis ideas. Another area that you might want to be interested in is the TA page scans. I came up with this years ago. I was just basically trying to shorten my overnight homework when I look at charts. Rather than going through hundreds and thousands of charts. I really just wanted to find like certain ones. There were certain setups I was looking for, and this page kind of sums it all up. It's actually really popular, and it just I kind of go through these charts. Usually, I do try to limit the results to about 20 per setup, and usually you can just take a quick glance at this and see how the overall market behavior is doing. Obviously, if there's a bunch of wide range breakouts, you know that we're going to be in much more of a bullish phase of the market. If there's more breakdowns, you're going to be entering more of a bearish phase. If you're interested in trading stocks at the 20-day or 50 or 200-day moving averages, this is a great resource here. You know, and there's pullback candidates, inside days if you're into those doji patterns. There's descriptions and webinars if you're interested in learning more about that. But if you're just looking to narrow down your search for trading opportunities, again, these are very liquid names. They usually have a daily trading range of a minimum $1. And I do try to keep them to about 20 results on each setup. So your search, it really takes maybe, I don't know, 10 minutes tops to go through some of the charts of these names, and then just to find one that you like or not. At the bottom here, this is a momentum indicator that I personally came up with about a year or two ago. It just tracks the SPY. It's not a timing signal per se, but it's based upon like daily, weekly, intraday movements, highs and lows, a couple moving averages, etc. And it really just tries to identify whether the market is favorable for buying or favorable for selling. It's prone to whipsaws occasionally, you know, when the market gets really choppy and we get some overt headlines and gapping news. But generally it does a really good job of keeping people in the market or at least giving you a bias of where to start. Obviously it's on a buy signal right here, so you know, you're going to be better off not focusing on pullback short candidates. If anything, you might want to look to maybe see some squeezes develop in these names. You know, same thing with you know, overbought names are going to become more overbought if this is on a buy signal. You know, you don't want to be shorting these the next day. TA page setups. This is another technical analyst part of briefing, and these are more taken from a swing trading approach or a position trading approach. These charts are usually really good at identifying key support and resistance levels, and the names that are usually focused on are generated from the emerging growth list stock. There's not much technicals on this page per se. It's mostly fundamental driven, growth oriented companies in the smaller to mid cap range. There is a relative strength component of it, you know, so we're not picking bottoms in these names. There is some sort of momentum flowing higher in them. The majority of the technical page setups, you will see many of those names highlighted. And occasionally, you know, from time to time, you get something else that isn't like a Baidu or something else. If you're interested in ETFs, the Industry Insight down here on the Trader Service, this is also a great area to, you get a much macro picture of what the market is going on, and sector-oriented, as well as different asset classes and different groups that are out there from one of our other analysts here. He does a really excellent job of identifying key patterns that are in the market, whether ready for breakout or not. You know, this is something that is just another area that you just should really glance at, and you get a nice view of you know, more of a macro, bigger picture type of look at the market. And then at the bottom there, we also have ETF notes. I believe this is highlighted, I want to say daily, pretty much almost daily, whereas the Industry Insights is much more of a bigger picture approach. The ETF daily notes is much shorter. I think Chart, if you ever see the name Chart up on the Briefing Trader Service, he's referencing these names a lot. Yeah, it is Chart. These are the short-term levels and near-term levels that he's probably looking to take some trading or some activity, activities and levels you should be aware of. The other area that technical analysis you got to get another perspective look at is under the swing trader column. I write this one as well. I update it probably about 2 or 3 times a week, depending on market conditions. I mean, on this approach that I take here when I write an article, again, it's definitely more situated towards a trend trading type of approach, and I'm always going to highlight some certain sectors and groups that I like. I'm also going to be focusing on a lot of relative strength, among those sectors, among certain groups, and whether the market is in some sort of overbought condition, or whether it's in some sort of oversold condition or coming into key levels, and what we should watch out for. And then the other area to watch would be the technical take. This is a daily column. It's actually you usually see a pre-market synopsis of what to expect for the day, as well as a recap at the end of the day, and it mainly focuses on the major indices, as well as some E-mini levels and some of the core ETF groups like the semiconductors, technology, maybe transports, anything significant that would be out there. But it's just definitely more detailed in the analysis and the levels that traders should be aware of. Usually the smallest time frame I've seen is a 60-minute approach and goes out to a daily. Excellent levels to pay attention to. And that pretty much sums up the areas for the technical analysis part of briefing. If we move along, identifying support and resistance zones. All right. Again, it's just a summary of where to find technical commentary. Also, the TechX commentaries on in play. That would be another area that you should be aware of. If you're watching in play throughout the day, you're always going to see some sort of stock. You'll see a stock that has testing a 50-day moving average, breaking out on volume. There's always these random comments that go out today on the momentum movers. But if you ever search under the TechX ticker, usually there's a summary of a lot of different levels and stuff that's out there. Support and resistance zones. All right, this is basic. The key thing I want to get across here is, and this is how I approach the market, it's zones. They say that technical analysis is an art form and not an exact science, and this is what they mean by it, because it's all about price zones, price areas, price levels, in the vicinity of a generalization of a price zone. If you try to nail this down to an exact science, you're probably going to lose often, because if you look at a certain level, there's always going to be a stop order somewhere. Somebody's always going to put their stop loss order or stop order to get triggered into a trade at a prior day's high or a prior day's low. And if you try to buy that exact low, or you try to short into that exact high, there's going to be stop orders that are going to get triggered when those get taken out, and it's just going to be more of a whipsawish behavior. So if you look at the zones, you're just going to be much better off identifying like a resistance zone. This was a resistance zone here on this chart of the spiders. February started, we gapped up, we retested it. It was a zone. It probed the level there because stop orders were there above the Feb 1st high. But then we came back in for 2 or 3 days, and then you could see that was the breakout above this zone. We pulled back in, held the prior resistance level, which was new support, and we began to just edge a little higher here the last few days. So this is another area. As a swing trader, it's a lot easier to focus on price zones of support and resistance. If you're day trading, obviously you want to go down to smaller time frames. I would say start on a daily, then make your way to 60-minute charts, and just focus on zones. Here you can see on the 60-minute chart of the spiders, we had a gap back on February 5th, and the gap created a support zone. Price pulled back 2 days later, and it held a support. It held this zone. If you started buying here, 105 and a quarter, you had to take some pain as your price dropped down around 149.90. Depending on the size that you took. But the zone held. So this is what I meant by you're definitely better off just focus on generalizations. You can see the resistance area that was up here that broke out and then held again. The same here. You can see just kind of these little tails on these candlesticks, and you can see that the resistance levels were there, and then we came down, we broke back through that prior support zone and held it as support today. So just some things to always watch out for when you're identifying support and resistance zones. If you have a longer time frame, obviously you're going to want to be more focused on the monthly charts. When you look at monthly charts, you definitely want to be focused more on the highs and lows of prior months. I also like to focus on whether the month was closing down or closing up for closing down or closing up on the month. Usually when you surpass a down month, a new trend starts, and usually when you go underneath an up month, a new downtrend begins. So just something to be aware of in this case. Like you can see right here on December, it actually closed a little weak, but then January we popped above it, and we have a new uptrend in effect. Same thing on the weekly charts. You can actually just look at them, and you're basically looking for any sort of reversal. Like here's a reversal right here, so that's going to become a new resistance zone. 2 weeks later, you had a resistance area. Here's a little reversal zone. Should have held as support. Eventually it broke down, became another resistance zone, actually became a resistance zone all through here, and then eventually you broke out above it. Let's see. Next slide. That's support and resistance. Use multiple time frames. Obviously, you have to determine if you are a day trader, you're going to be wanting to focus on the shorter time frames, daily, 60 minutes and less. Swing traders usually benefit more from the weekly, daily, and monthly is usually for a better investing time frame. I don't want to go to trend reversals yet, so let's see what I have listed here. Trends. All right, so how to draw a trend line. It's pretty basic stuff. It's not too complex. Let's see. So if I just go something like a CVLT was one. There you go. What I like to do when I draw a trend line is I always try to start off with a 45-degree angle. I just take a major low or a major high that I can see, and I just draw a 45-degree angle. And then I basically go from there, because it's amazing how this works, this 45-degree angle. If you just kind of focused on opportunities on the long side above it, you know, that obviously the trend is your friend. It's going to work very well. And when price starts trending below a 45-degree angle, you want to be looking more to short or just get out of the position. If your trend line is more sideways like this, you know, right through this range, obviously you got to be able, you have to, you could be caught in a range, and you either have to avoid the stock or you have to use some sort of strategies that could strategies used for ranges where you short into overbought conditions and buy oversold conditions. But generally speaking, it's a 45-degree angle. And then, you know, I try not to make this too complex. You know, you just want to see where buyers stepped in. So we're above a 45-degree angle. I'm just going to try to generalize. Again, this is a price range that I'm looking at. So it looks like buyers began stepping in around this vicinity here. Broke out here. You know, they held a support level here, which lined up over here. And you can almost extend all your support lines. Hopefully, everyone has a trading software of some sorts that they can actually draw these trend lines on. If you don't, I know stockcharts.com is a great free website. Freestockcharts.com is a great website. But for the most part, drawing trend lines, it really should not be a difficult task. I try not to get too specific with them, because there are days, you know, of connecting the exact lows. It's just a generalization where you should draw your trend lines, and should be pretty self-evident stuff. Just eBay, for example. eBay clearly is a support area right here around 52, and then the gapped up, came into the gap, held another gap higher here, held right along there. So pretty basic stuff. A 45-degree angle for a trend line. You know, even if you started over here, just draw a 45-degree angle, comes in somewhere around this vicinity here. Just a really strong-looking stock. For the downside, you know, I'll just go to Apple for an example. Let's take out these trend lines quick. Oh, anyway, you know, you could just take a downtrend line, start off a significant high, you know, and just kind of connect the lows here. You can just see that, and trend lines have to be redrawn. Like I said, this is not an exact science. It's okay to redraw your trend lines or make different ones as time goes by. You can just see, you know, you're going to be, since this is a 45-degree angle down over time, you just going to want to be more focused on the short side. Trend reversal patterns. Let's see. All right, without getting too complex and into like Elliott wave type of stuff, trend reversal patterns, they're easily identifiable. If you look at the slope of a line, obviously I just talked about 45-degree angles for trend lines. The steeper a slope of a trend, the more likely, the sharper the correction is going to be, and you're going to get that V-shaped type of, a sharper pullback or a quick up and a quick type down move. The flatter or the more steady a slope is to the upside or downside, it's usually not going to be some sort of trend line break that just immediately, stock is, the whole game is all over. It's going to be something more of a three-step process where a trend line will be broken, and you're going to see some sort of reactionary move in the direction of the primary trend, and then you're going to see price roll over again. There are some exceptions, and this is what I kind of drew over here. If you have a trend line that is holding, and then you go to some sort of new high above a previous swing high, and then you break the trend line, and you break that previous test of the swing low, which is a support area. In these instances, usually you have a much more significant reversal of a trend, and it works the same to the downside. And this works on all time frames, by the way, whether you're a weekly, daily, 60-minute, 5-minute charts. You can see this all the time. So if there's a downtrend here, again, you take out the prior swing low, and then you reverse not only back up above the prior swing low, you break it down trend line, and you surpass the reactionary high. It usually means there's some sort of new uptrend that's going to take hold. Certain examples of this, let's see. I'll use the QQQs as a example of how to draw these. So here would be, actually, let's go back over to here. Just generally drawing trend lines, let's say. So you can see that the downtrend, well, let's start over here. This is easier. Yeah, this is like textbook. So here's a downtrend in play back at the November-December highs of 2011. And you can see we had a rally back up to the downtrend, comes down. When you don't surpass that swing low, and then you eventually break out above it, and you break a downtrend line in that process, and you clear that reactionary high, usually a new uptrend is going to take hold. You can see here on this one, this was a very strong uptrend. Price broke down, but again, it's not like it's going to just continue lower just because of a steady trend line was broken just once. It's always going to be some sort of reactionary move in the direction of the primary trend that's in effect. In this case, he actually squeezed much higher, just extending this whole trend line outlook. The trend line broke, just a little bit more steady, reactionary move back, and then you took out that prior swing low. And it's taking out this prior swing low here that usually is going to be just way more significant that you have to watch out for. Here's the uptrend again here. Check out the trend line, reactionary move in direction of the primary uptrend here. Usually creates some sort of bear flag pattern. And then once you take out that prior low, that prior swing low, that initial breakdown low, then you usually have some sort of significant trend change on your hands. If we focus on where we are now, it's a little bit more sloppy, but again, 45-degree angle goes up around this. I'd even be more inclined to just attach this like that, and you can see there's a trend line there. Sometimes you can also use the upper channel lines if the trend line is pretty significant. It looks like it's not really, doesn't look too hot in this example right here, which is usually a good sign too. Like if something's not there, don't try forcing it. Don't try. I know there's so many patterns out there. I try not to force too much of what I see out there. If it's not clear on the charts and I can't identify it in 2 seconds, I don't really focus on it. I don't try to make things too complicated when it comes to this business. That's pretty much that. I'm trying to just touch lightly on some topics today, because I want to keep this webinar short. I have a tendency to go way too long when I get into detail with stuff. Earnings. All right, let's see what we have for some earnings movers. We can look at earnings. It's one of these things that I highlighted here. For me, it comes 4 times a year, and it's always a wild card. It's a 50-50 chance of whether you're going to see investors just dive in and just start buying stocks up, or they're just going to completely unload their positions. It can destroy a great chart pattern, or it completely make you a lot of money. So it's just it's one of those things you just have to be really cautious of and be aware of as earnings season rolls around. As a general rule of thumb, the bigger the move on earnings, or the bigger the reaction, the bigger the gap, it's going to be much harder for it to reverse. If you're day trading, and I guess before I go on, I guess what defines bigger, I would say any sort of gap or move that is outside of its normal range leading up into that time frame. So if a stock is usually trading about $2, give or take on any day, over the course of like a month, and then all of a sudden gaps $3, $4, $5, it's going to be a lot harder for that to just start reversing on a dime. If it's a breakout pattern that just off the opening runs up hard, a fast dollar or two, it's usually going to continue. It's usually the smaller gaps and the smaller percentage moves that are more prone to reversals. And the reason why that is because the larger the gap or the larger the move in response to earnings, you got to think about the funds that just have massive positions in these things, and the people that just took huge bets the opposite direction. If they're wrong and the price goes against them in a big way, they have to start covering these positions, and they have to start unloading them if it's going down. That's going to put some sort of sustained pressure or underlying bid or offer on a stock as these bigger funds have to unload or cover their positions. And that obviously because they have to keep risk parameters within portfolio means. The shorter the gap and the smaller the gaps, it's going to be a little bit more manageable, and they would actually be able to add to their size, or short or long. Day trading, this usually you have to look at the gaps, look at the breakouts, etc. It's usually best to wait for the first narrow range pause. Usually on a 5-minute chart or a 15-minute chart, and then look for some sort of resumption in the direction of the gap. Tests of the 20-day moving average on a 5-minute also works very well. I'll speak a little louder. So, for example, we saw like racks today. Big breakdown, big gap down on earnings. As a percentage mover, you can see this is a great example of what I'm talking about. So the stock closed around 75 yesterday. It gapped down 13%. That is a monstrous gap. It also took out about 2 months of trading activity. Something like that is not just going to gap down this low and start turning. There's a lot of trapped money and trapped longs in this position, and therefore they're going to put pressure, trying to get out of it, especially if it's a major fund or a major name. And you can see that even though the stock opened down around $65, it did sell off another $5 throughout the day. From a day trading perspective, you could try to. I usually like to go to a 5-minute chart initially, but you really want to look for some type of pause. And when I say pause, I'm talking about when everything subsides, when the money just the stock just completely takes a break from all the activity, and that's usually identifiable through some sort of really narrow range or doji pattern. This would be a great example on a 5-minute chart, where the buying and selling just kind of dried up, and then you're just looking for a resumption to resume. Another great example was maybe about an hour and a half in the day. You can see a couple doji patterns, which are these really tight closes right here, really, really narrow range here on this bar right there. Let's zoom in there in case this is hard to see. So you can see this is some really narrow range action going on here and here, and you're just kind of waiting for a resumption of the selling to resume. And this works really well on names that gap significantly. To the upside, we had LinkedIn, we had Netflix recently, and you could basically apply the same strategy to these names. So LinkedIn had earnings last Friday, and on this 5-minute chart, again, you could start chasing stock, and it gaps up big. It was a significant size gap, so you knew people getting squeezed out of a position. So it's not something I'll be initially willing to fade. But after like an hour or so, you could just see that the the overall pressure of the stock, just kind of the overall trading activity just dried up. Here's a really tight, narrow range right in here. And this is usually an area that I would like to, if you're scalping or you're day trading, you want to start paying close attention to. Here's another example over here. And you can see you're looking for these really narrow ranges in order to continue the initial move higher or lower in case, whatever the direction of the gap was. You're just going to wait for those narrow moves. It's not just 5-minute charts, too. Obviously, you can look at it on a 15-minute time frame might be best as well. You can see this was like the most narrow range bar was right here, about an hour after the stock opened, hour and a half after the stock opened, and then it just kind of continued higher. Another stock today, let's see, was it Cleveland? I think it was actually John Deere. Here on this 15-minute chart, earnings reaction, really crazy action the first 15 minutes, bounces, gets crazy. There's an inside bar in a 15-minute chart, not bad. You could take that as a short. But this one to me seems a little bit more intriguing. It's about an hour and a half after the first hour reaction, and you wanted to take a short once this low is taken out. Here's another one here, more of a doji pattern, really narrow range, and you could dig in a short below that level. As the day goes on, it gets closer to midday. This pattern isn't the greatest in the world, but what does work really well is, like I said, the 20-minute, a test of a 20-minute line on a 5-minute chart for a lot of earnings movers. The 20 moving average for Senior charts, you got to get it on there. It's probably one of the closest thing to the Holy Grail. I think it's actually coined that in certain technical books and articles. But a test of a 20-period moving average on a 5-minute chart for a stock that has earnings, in the direction of the gap, is often a really profitable day trade. Let's look at RAX. RAX didn't touch its 20-period moving average until midday today and stalled right at it and then wound up sinking lower. You can look at LinkedIn a couple days ago. So LinkedIn on its earnings took a while, didn't really touch it till the afternoon. Obviously, I don't like trading earnings plays way deeper in the last hour. A lot of the setups are really kind of gone, so it's it's kind of tough to take that trade in the afternoon. Let's see, what was another one? I mentioned Deere, Rax. Cleveland Cliffs, I think, had earnings today. I got hit pretty hard. Yeah, Cleveland Cliffs, another big gapper. You can see it closed around 36.50, dropped down to 31 for a 15% loss. Again, that pressure is that you're going to see a lot of funds unloading, and it's just going to keep the pressure on the stock. You got a couple nice dojis that maybe you could have shorted into for a scalp. But then again, the first test right here, the 20-period moving average, just stalled out, and then price sunk. Just something you might want to consider looking into if you are day trading those. From a swing trading perspective, I'm more inclined to look at the first test of a gap, of an earnings gap, I should say. The first retest is usually going to hold. So I guess the best way to describe that would be something like F5. F5 gapped up on earnings here on January 24th, and 3 days later came down and retested the earnings gap right here along the 102 area, and just found buyers. This happens often. It's an excellent day trading play, and if it closes in if you picked up stock here and it closed in your favor, it's a fantastic type of swing trading opportunity that you can probably hold on to for a couple days. Another great example, I think, was Under Armour. So Under Armour is, it gapped up on earnings into late January. 2 days later, probed the earnings gap, and then the next day shot up about $1.50, $2 if you took the entry there. It did eventually wind up failing. Obviously, the more times it's going to retest that gap, it's going to be more prone to sink lower. But as in general, you want to always watch the test of an earnings gap. I have a few more examples too, like Facebook. I believe it had earnings on the 4th, and you can see here was the gap. 2 days, the earnings gap is right in here. You could probably take a short as the gap, is retested, and sure enough, it resumes in the direction of the trend. It's always good for a nice little swing trade. If it fails, if you took that short, and then you realize that the next day it just continues higher and closes the gap, you got to get out of the position. It just means that the buyers are just way too strong in that name. Another one that I had, Chesapeake was a little bit different. I believe this was earnings or some sort of news that came. This sold off. It gapped up big, sold off. So it's a little bit harder to buy the next day, knowing that it sold off during the gap day. But if you look a week later, the gap area was tested again, and then it just shoots right back up again. So always watch out for your retests of your earnings gaps, especially if it falls within, I'd say, about a 2-week time frame. It's definitely a really nice trade to be paying attention to. Let's look at this one. Here's VMware. Here's another one, earnings gap. Monster drop. This was, what was the percentage here? Well over 15, 18%. It's just going to keep pressure on the stock as big funds are unloading. Didn't really come back and touch the gap exactly, but if you're a swing trader, you maybe was looking to short into it on this retest about a week later and then drop. I think that's a key thing to recognize too with earnings is don't always feel so obligated to run in there and start trading right away because momentum's there and the hype is there. More often than not, the best opportunity is going to come a few days later after the dust settles and everyone forgot about the name. And this is usually the time when you can just kind of go quietly in there and just pick a support and resistance level. When everyone else is chasing the next hot thing, you can usually slide in for a really nice swing trade, nice day trade at these key levels. So definitely something to pay attention to. Overall, I'm just going to go into just a general market stance because I want to wrap this session up. I do take a top-down approach to the market. What that means is I look through all the major indices each night on a daily, weekly chart. I also look at 60-minute charts on them, and just try to identify the overall primary trends, whether there's some sort of overbought or oversold condition, on RSI or stochastics. Also look at market internals, new highs, new lows. I look back at the TA page, see if there's significant bullish sentiment or negative sentiment there. You can also look at the swing trader page, and you'll see that I also cover a lot of different types of technical indicators and to judge the overbought, oversold stuff. And I try to go down. I try to take that overall approach there, and then you go down to sectors. For sectors, I just look at the 9 or S&P sectors, mostly ETFs, financials. I do have a screen right here. I'll show you that I look at all day long. This screen here is basically this is all a 5-minute chart on these names, but they're usually the more active sectors. I have energy right here. I have the S&P. I got the Qs. Got the diamonds over here, financials, you always got to keep an eye on them, industrials as well. And then down here I have my more daily charts on the bigger asset classes like the the US dollar, gold, and crude. And always just keeping an eye on these things and seeing how their markets are interrelated to one another and just to try to establish a bias for the day. So that's just something I, in part of my nightly homework, always try to establish top-down approach. So right now we're in market's in uptrend, although we are looking a little bit too overbought for my taste. Now I'm going to start going to sectors. And again, you want to start looking at just the trends, key moving averages, overbought, oversold indicators. Relative strength is huge. What sector is outperforming the others? Money, positive money, follows positive money. Negative money follows negative money. If a trend or a sector is winning, it's going to continue until it no longer continues. So that's, it sounds real simple, but it's really if you focus on not bucking the trends, you're always going to wind up having more profitable trades than losers. As for groups, obviously each sector can be broken down into groups. A financial sector can be broken down into real estate, into mortgage, into insurance, into asset managers. They have different breakdowns. And then eventually, when you find good setups and good trends and good levels, you look at the individual stocks. Again, that's the top-down approach to technical analysis. If you want to narrow it down, again, you can go to the TA page scans. you can go to the ETF notes on our Briefing Trader site, and or you can just look through the liquid momentum and BLUEX and value lists that we have, and just to really kind of focus on your search depending on your style of trading. There was a topic that I wanted to cover right here before I move on. Check the notes. So, all right, I think that was pretty much covers it. Managing risk. As with everything, if you're really struggling to make money on a consistent basis using technical analysis or looking at our site, there's so many ways that you can manage your risk. First, stop trying to hit home runs. If you're really in this business for the long haul and you just want to accumulate wealth, and grow your capital, you also have to preserve it, and you have to put in some really good risk parameters. And one of the most obvious ways is just to trade smaller. Obviously, your profits are going to be a little bit smaller, but you're going to be way more patient with trades, and you're going to allow trades to work in your favor. If you're trying to day trade on 5-minute charts or smaller and you're failing miserably, you need to move up to 15-minute charts and 16-minute charts. Bigger time frames are also going to allow you more leeway in your analysis. If you are not making it as a day trader, you consider swing trading. Take smaller positions, focus more on the daily and the weekly charts. And also, you want to give yourself a little bit more wider stops, which means you're giving yourself more room, more patience, more time for things to work out. You want to trade less frequently, if that's a big thing too. And if you're a little bit more experienced, you can actually start taking, hedging positions properly. I usually don't hedge a position until I see a profit in it. A good example for anybody that's been part of the trader service was I took a long in Deckers back around Christmas time. Just under $35. That was right over here. A couple things that alerted me to take the long was this doji pattern had showed up on the TA scans page. It was a doji pattern right here. I believe it was also one of the oversold names on the TA scan page. So what I did is I took that name, I looked on the chart, and I saw that there was a nice gap support here right in play right there. Looks like a previous resistance area that was broken with a gap support, and it was about to hold. We had oversold conditions on stochastics at the time. I believe RSI was it was mediocre, nothing special. And I decided to, once I saw prices being bid up here to $35, we took a swing long in it. We had about maybe $1.50 risk on it. A couple days later, it just shot up, took a partial profit into here. I believe when it shot up and gapped up here on this day here on Jan 1st, around 42. By this time, I had already taken 2 partials in the name, and I only had a small position left. So I think I took a partial profit here, and I gapped up. Anytime a stock gaps in my favor, I'm always going to take a partial profit. Gapped up here, and I actually sold some February 45 calls against it, which was right over here. And the stock pulled back in. The calls made money on it. We still held the position. Actually, it might have been January 45 calls. But the stock came back in, and we still had a small remaining piece from 35 area, and then the price shot up again. I think when it shot up here at 42, I sold 45 calls on the site, and so here I am with a 10-point gain in the stock, and made some money just by hedging it a little bit or protecting my profits by selling a covered call against it. That's pretty much what I mean by hedging. Let's see, what else can I cover here? That is pretty much it. I'm going to go to Q&A right now. I just kind of gave a really broad overview. Hopefully you got 1 or 2 things out of it. More of the webinars are usually more detailed and topic specific, but I just wanted to cover some of the key ways to approach the market with technical analysis. For questions. All right, so somebody just wants some basic stuff on the language that you're going to see on the trader product. Most of us are technically oriented on the trader service. Obviously, it's mostly momentum-driven, headline-driven type of news. So scalp trader chart trader, they're going to see more technical terminology from those guys. So stuff like squeezing basically means a very fast move in the stock to the upside. A great example today would be the QQQs. So on this 5-minute chart here, we opened up, we pulled back a little bit, and then we jumped. What was it? 67.85, almost jumped about 25 cents in a 5-minute bar. That's a squeeze. That's not normal trading activity. Plunging, diving lower, would be the total opposite. It's basically a wide range bar, up or down. Squeezing is basically shorts getting squeezed, and shorts being forced to cover. Obviously, to the downside, plunging, diving is sellers just completely hitting the stock. It's not normal behavior when you see stuff like that. Normal behavior is actually much choppier, more controlled. These wide range bars like this, where you pop hard and then dive lower, is squeezing and diving. This is some terminology you can see with us. Acting heavy here means that feels like there's sellers in a stock under accumulation, obviously. But if something's heavy, it just means that it's losing its momentum. I don't know when the terminology was used, but just means that it's heavy. It's heavy. If something's heavy, it's going to sink. It's going to go down. So it's usually not. It's not really rocket science, but you can almost think of, just think about what the term means. You can usually apply it right to the chart. Fading something, obviously. A fade would be something that's trending higher, but fading means you go in the opposite way. But but you're not going to go hard. You're fading it lightly, fading it into the distance. So if something like this runs up, someone says they're fading it, it means they're going to take a little position, on the short side here. If it goes higher, they're going to just maybe add to that short position. They're fading it. They're not really going. They're going the opposite direction, but they're probably not going to go. They're not going all in. You're slowly fading counter trend. If something gets flushed, obviously it's to the downside pretty hard. Looking for something to roll over. That's kind of self-explanatory. It just kind of means that something went up a lot. And, for example, today's action in the market, price bounced midday. And if somebody put a comment around here that said, hey, I'm looking for this to roll over in the afternoon, it just kind of means you're looking for it to, roll over to the downside. And fading a gap. If somebody's going to fade a gap, it kind of means price moves into a gap and they're going to go the opposite direction. It's kind of like a pullback into the gap. This is just basic terminology. If you just watch the site and look at the charts, you get a feel for it. If you're new to this stuff, I highly recommend not acting on things that you don't understand. Definitely just observe, watch, try to learn. Feel free to shoot feedbacks or emails to us if you can, and we'll try to help. But usually the response time is pretty good. We'll help out where you can. How often do we update the charts? Different charts on different services get highlighted different areas. Again, it's all subjective to each analyst and trader's opinions on the market. So if I scroll through the charts and I don't feel like there's a trade there that I would personally take, I might not update anything for that day or 2 days at a time. Things change. I want to capture the more significant moves. So I'm only going to post, things that I think traders should be well aware of. But generally speaking, something like liquid momentum is updated 2 or 3 times a week. Swing traders updated 2 or 3 times a week. ETF notes are probably updated, a little bit more frequently. You kind of get a feel for it. Again, there's no real set schedule that we follow. The market is very fluid and moving, and we try to just go with the flow and see what it gives us. All right, somebody said I should point out the webinars. Be sure to look at each page, especially with the technical analysis stuff. There are other links to user guides. There are other links to webinars that we've done in the past. Here's a webinar on accumulation distribution patterns that I recorded last year. Another one through high probability chart patterns. Again, these are more detailed webinars where you can, and you're going to see a lot more of these throughout time. Usually one comes every few weeks or every other month. And just a lot of good information there as we focus on one topic. Uh, Tell me how to identify that it will go down more after gap down. You're really fading in and out. I apologize if the sound was kind of in and out. Let's see. Somebody wanted me to just look at racks real quick. So how would I have known not to be a buyer? I'm just going to cover this again because earnings, it is appropriate right now. So why would I have not have been a buyer? It's the significance of the gap. There's a few things that I try to look at. First is ATR. So ATR is basically the average true range in a stock. Over the standard default is 14. Give or take, prior to earnings, it was trading around $2, right? So in my mind, if the reaction to earnings is a gap bigger than $2, I'm probably not going to fade that gap. That means it's going to be a significant movement that's going on in the name that I'm just not going to fade. Sure enough, price gap down well more than $2 than its average daily range. And again, that's going to put, you just got to have to think more like big money. If you're an institutional investor, and you've been riding this trend up for the last 3 months, and you've been adding to your position along key moving averages or trend lines or support areas, right? And there's just bullish activity going on. And here you have a failed breakout. Which I believe this was Liquid Momentum, one of the top stocks. Hopefully I highlighted it in my column in January, because this type of activity where you break out to a new high and then you wind up failing and gapping down and you break below a trend line, it's usually not a good sign. You have the support level there. Again, this is where that whole trend reversal type of thing comes in play. You're not going to really. The slope here is about 45-degree angle. When that breaks, don't get too aggressive on the short side unless it's like some horrific news, like the company's going out of business or something. But 9 times out of 10, there's going to be some sort of reactionary bounce in the direction of the primary trend, and that's where you want to pay attention to. Actually, this is a fantastic chart and a lot of things I covered today. So not only did we have the 45-degree angle break, and you had a false breakout up here, but here's this gap. And this is that classic thing that I said, watch the gap. This wasn't earnings. There's probably some sort of downgrade, I'm assuming, or a reaction to one of its peers, or some sort of headline. But it's all the same. So here it comes back into the gap. It's a retest of the gap, and that was an excellent shorting opportunity. I didn't see that happen at the time, but again, this just goes to show you that sometimes not reacting the initial day to news and waiting a few days to see what the retest looks like is going to be where the better opportunity lies. And you could just see it just couldn't get back above this 20-period moving average, one of the key moving averages that should be on everybody's chart. Again, below it is bearish, above it is bullish, and it's just struggling here, struggling here, struggling here. Gaps down significantly. Any fund that was accumulating this that wasn't getting rid of it here, on this break, on this bearish activity, and was waiting for earnings, they're probably underwater here, or they're looking to get out of it, or they're looking to cut their losses. It's just a significant size gap, and that's why you're going to see pressure on this stock pretty much all day long. It's the same with Netflix. We can look at Netflix. This was a liquid momentum name prior to earnings just because it had a nice strong uptrend. It was holding the 20-day moving averages perfectly. Earnings come out and it gaps up almost 40 points. I mean, that's well beyond normal. That's beyond any sort of means. Yeah, it's like almost hitting like the reset button on a chart. When you have a gap that big, it's like a whole new ball game. You just have to start from the beginning and pretend it's like almost like an IPO that just came out. And you got to realize that all the positions that were short are just going to be, they're forced to cover. There's no way they're shorting more. You can't just short. You can't tell your boss or your clients like, oh yeah, I'm short the stock here, and it's up 30, 40% in one day, and I'm now going to short more. It just doesn't work that way. You're going to be forced to take that loss or mitigate your losses somehow. As the squeeze continues, it's just going to be way worse. The only thing with earnings gaps too is, stocks do tend to get a run away from people. This one never really came back to this support line in the next following week. I am watching the 20-day, trying to catch up onto it. I would suspect when the price comes lower and the 20-day comes up and meets it, it will definitely find support on the first test. Similar to Valero, this is another one that's a strong performer, gapped up big time on earnings, just never really pulled back into the gap for buying opportunity. Another refiner here that was on our liquid momentum focus list. If you are watching the liquid momentum focus list or the emerging growth list, obviously we screen for strong technicals and fundamentals, so there's definitely going to be a bullish bias to them. Be aware of the possibility of negative or bearish type of activity that flashes warning signs that you probably should back off on. But generally speaking, you're always going to find some sort of, you should be leaning bullish on these stocks or establishing some sort of covered call positions in them. They work really well. Let's see, did I post deck trade? Yes, I did do the deck trade on, the deck trade was under BlueChipTrader back in January, yes. Where are the other webinars? Again, just go to each page, and you could usually see them right above each one of these lists. You're going to see different links to user guides and stuff. How many trades per week on average do I post under BlueChipTrader? It really depends on market conditions. I mean, 3 weeks ago, I was pretty active, on the dips and the breakouts and stuff like that in the market. Now, I'm not really liking much up here. And it's expiration week. I tend to slow down my trading a lot around expiration days and expiration weeks, especially when I feel like the market's overbought. I much rather, just looking at the SPY here, I'm the kind of guy that I'm going to be more active when price is closer to a moving average than I am when it's well extended above and the market's in a multi-day uptrend. During this uptrend here, after the 5th day going higher, I can just tell you right now that I wasn't taking any long positions, and I probably was looking to start getting short stocks or sell some calls in some stocks. But now, after like a 4 or 5 day pullback consolidation, I initiated some new trades in early February, and I'm riding the trend higher. So, on average, I'd say I don't know, somewhere between 5 to 10 trades a week. But again, it really depends on market conditions. Scalp trader, obviously, he's usually all over the news and big gapping names and earnings names. So he's obviously going to be way more active, every day in about 3 or 4 different stocks. Similar to chart, you're going to see just more activity among those guys. They tend to be much shorter time oriented. I'm a little bit more slower and watching, from a swing trading basis. I'm reading Q&A questions here. The seminar's over, so if you want to log out, that's great. I'm just going to kind of just review things here as fast as I can. I am BlueChipTrader, in case if that wasn't clear. In the liquid momentum rankings, how old is the short interest? To be honest with you, I don't know. I assume it's 30 days. I think that's the standard in the industry. I have to go look that up. I don't know. You can actually shoot me an email, and I can get that answer for you. I have to go to the creator who put the algorithms together and ask them. Let's see. There will be a recording of this webinar, obviously, so you can always rewatch it or check it out later on. What's the best analysis for checking overbought oversold condition? I have a theory, when it comes to technical indicators. Generally speaking, I feel like they were created around the major indices and around major asset classes and for commodities types of trade, commodity type of assets, like gold and crude, etc. I don't think they were actually created for trading stocks. Somehow they morphed into that, but I think the original creators of a lot of indicators, they always seem to, if you ever look at all the examples in the textbooks from a long time ago or from whenever, their main focus is always a major indice or a major group. I don't think they actually ever designed it for individual stocks. There's just too much of that X factor going on in individual stock, whether it be an upgrade, a downgrade, an earnings play. Obviously, they've adapted over time. Traders take it, but I think when it comes to overbought, oversold, conditions. I definitely would look at RSI 14. I use RSI. I actually change around. 14 is about 2.5 weeks. But if you're a shorter time frame person, you might want to just adjust it to 5 days. If that's your time frame. Usually, I'm a swing trader. I definitely focus on overbought, oversold on a 5-day time frame. Obviously, if it's an uptrend, you can have overbought conditions exist much longer than you plan on it. So you obviously have to recognize the trend first, and then look for the dips as a buying opportunity. I've actually seen some people drop down to as low as 2 periods on RSI. Again, overbought conditions can stay overbought for multiple days, so don't try just shorting it. Take it in context of the trend. But on those 1 or 2 times that they dip into oversold territory, there is a quick reactionary move sometimes. Not all the time, obviously, but you got to just take it into context with everything. Let's see, copy slides of for trend reversals. I think MACD is another good. Obviously, if the MACD is trending higher, the histogram is positive. Probably want to be more focused on the upside. For those people who are actually a little bit more longer-term oriented, one thing I've been experimenting with is, MACD does tend to be a little whipsawish. So I was thinking of a way to actually take a longer time horizon on it. And what I did is I just doubled the standard readings. So that would be 26 would be 52, and 9 would be 18. And it seems to be doing a really good job at just capturing a much more intermediate term momentum base. If you just look at this, so what I did is it's basically a MACD doubled, and you can see that it does a really good job of identifying just a momentum trend. And then when it turns, you can almost get out of it. It's just something that I've noticed recently. Obviously, we've had a really good trending market here. In more bear markets like this that we saw, things get really erratic and the gapping up and the gapping down. Gapping down, you're going to see, a lot more whipsaws. But when the market becomes a little bit more smooth, it's almost like a decent momentum, general trend following strategy here. You can see it's still pointing higher. So you should be favoring the long side on dips. My trading style, again, I'm mostly a swing trader. And I do trade small because I'm doing this consistently. I just try to accumulate. Whenever I trade big, I usually get way more nervous. I panic out of every move against me. I stay glued to my computer screen all day long. If I carry a big position overnight that I know I don't sleep well, I'm watching the market, I'm watching the news. My life just revolves around that giant trade, and I don't like that. So I really try to trade small. By trading small, I just have so much more leeway. Usually my average, I don't usually, I start off with a risk of $1 on almost everything, and I'll go up to $2 or higher if I have to. I just keep small positions. Again, this is all about price zones or areas that I'm interested in getting involved in. I do analyze different time frames, but for the most part, I want to be a swing trader. I want to give things time to work. The faster they work in my favor, I'm more likely to take a little bit of profit off, just to maybe cover commissions or just to feel a little safe. And then once I take a partial profit in something, my stop just goes right to break even, and I just let that ride as long as I can. DEC was a perfect example of that by picking it up in December at 35, and took 2 profits on the quick run-ups, and then I'm still long the stock here 10 points later. Another one that I had was ARM-H. ARM-H, I believe I picked it up right around here on the test of the 20-day moving average mid-December on the service as a swing trade. Just a nice pullback. It's a leading name, 45-degree angle up. Took a while. Actually, it might have been over here on this initial pullback around here. But either way, I like the stock around $36, $37. Took partials, obviously up $1 on this breakout here, and then hit 40. It took another one, gapped up. Anytime it gaps up significantly, took a little bit more, but I didn't want to get rid of all of it just because I like the strong uptrend. I like the fundamentals. It's a liquid momentum name. There was no earnings, nothing on the horizon that I really wanted to get rid of it at. I was still holding a little bit of the position for a nice, what is that, 8-point gain at 44. I was thinking about selling covered calls against it, but I don't think the premium was there enough for me to actually to make it worthwhile. If you have any other questions, you can contact sales at briefing.com for more about the trader trial, or just trying to get pricing information on that. You can send an email to me. I think I'm going to go back. I think it's on the home page here at smith@briefing.com. And that pretty much sums up the webinar. I hope everyone has a good Valentine's Day tomorrow. Don't forget to buy flowers and candy for your loved ones. And thanks a lot.